Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with Martin North. How are you, Martin?
I'm very good. How are you going?
Yeah, very well. So, you've been to Wimbledon and the Ashes.
I had fun. I was there at the Ashes in London on the fifth day, which was pretty amazing. And yeah, I also went to Wimbledon. I'm really enjoying being able to get to places because, in Australia, everything's so far apart, right? It's like just down the road in the UK. It's great.
So, we've got a new RBA governor on the way in, and I believe she's one of the more neutral or more aggressive ones compared to the other candidates in terms of being keen to raise rates.
Yeah, so it was an interesting process, and of course, the mainstream media was sort of celebrating the new governor. I mean, she's been around for a long time, and of course, was part of the team that's got us to where we've got to. She made a speech a few weeks ago saying unemployment will have to rise, 4.5% or whatever, and inflation is going to be there for some time. So this is very much a continuity candidate. And what I find interesting is and disappointing is that we are not actually going to see a change of trajectory or direction. It's going to be the same old, same old. There's going to be a bit of cultural difference, possibly, because I think Philip Lowe was in a particular way, whereas Bullock is going to actually perhaps be a little bit more inclusive, etc., etc. But in terms of dealing with the fundamental questions about the role of the central bank, what it can, what it can't do, and all those sorts of things, they're going to continue to pull the inflation lever, the interest rate lever, to try and deal with inflation. And so I was very disappointed and frankly felt a bit let down by it. But, if you read the mainstream, everyone's saying, yay, great choice.
Yeah, okay. Well, they normally do have their backs, and they're meant to be independent, but there's definitely a relationship there between the government and the media as well with the RBA.
Well, the fact is the RBA has been doing the heavy lifting because the government isn't doing the things they should be doing. There's a lot of superficiality, in my view, about what Chalmers has been saying. They're not actually dealing with the fundamental issues around productivity. There's a whole bunch of reasons why interest rates are being forced higher. Some of it is actually government policy, let alone what the RBA is doing, and that's high migration. Another example. I mean, there's so many things that should be being done but aren't being done, whereas the government is now sort of backing off and say, well, it's the RBA's problem, and this is a problem of central banks. Central banks created the inflation problem in the first place with their ultra low interest rates and their quantitative easing and all those sorts of things. They created the problem. But to solve the inflation problem, we need governments to be doing other stuff too. And in Australia, they're not. In fact, they're part of the problem. Look at the energy problem.
Yeah, the first slide here is covering the labour market and that projection and increase of unemployment.
Yeah, so, that was a slide from Bullock's presentation, right, which showed that their expectation is that unemployment's got to get to about 4.5%. Inflation will come up and then come down, but it won't be really until 2025. So that's their base assumption, which means higher interest rates.
Yeah. Raining jobs, so better than expected.
Yeah, this was a surprise. So everyone was expecting the unemployment rate to be ticking up, right? Remember what I just said in the RBA saying you need unemployment up at 4.5% to get this supply-demand thing in balance. Well, guess what? In fact, the numbers are going the other way. And in fact, more people are actually working multiple jobs. More people are having to work longer hours simply because they're trying to get by. So there's a real disconnect between what the RBA wants to see and what we're actually seeing with regard to the jobs numbers, which means that the economy is probably a little bit more buoyant than they would want to see. Remember, they are trying to engineer a slowdown, bringing supply and demand back into imbalance, and yet the jobs numbers going effectively for them in the wrong direction.
Yeah, I guess one point I'd like to add is that this is the first sort of time that if we head into recession that we've had such a wide gig economy. And so I don't know whether some of the older members on these boards, whatever, they take that into their models into account. So it's easy to sort of start driving a bit of Uber on the side or whatever, and these can all make it look, the unemployment numbers look slightly better as people start to lose their jobs and turn to the gig economy. So that's an interesting thing to keep an eye on as well, I think.
Well, and of course, there's a definitional issue. So unemployment is a particular definition that the ABS uses. The other more unofficial official number that Roy Morgan produces has a much higher number, so it depends on how you count them as well.
Yeah, absolutely. That higher terminal cash rate still only at 4.5%, but a lot of these other countries, again, terminal rates they're talking about 5 or even 6%. You know, the US, UK, Canada, and so on.
Yeah, well, the UK in particular is talking about maybe 5 or 6%. But in Australia, the point is this chart shows the forward view is rates will go higher from where they're currently at 4.1 and then come down. But look, in December 2024, they're still expecting them to be pretty much higher than where they are now. And that's important. And in fact, if you look at the next slide, which is the 2-year bond, that's at over 4%. So, you know, these rates, we're getting back to normal rate setting. Let me underscore that again, normal rate setting. So what we saw over the last 2 or 3 years down to 0.1%, that was abnormal. That was artificial. That was created because of bad central bank policy, response to COVID, all of those things. We are getting back now to more normal levels of interest rates. And so the key question from this point forward is, will we see those rates drop back down again? In other words, will central banks have to turn turtle and drop rates because the economy crashes, or will we actually be back to rates that are more normal? And, you know, 4% for the 2-year is, you know, lower end of normal. Yeah. That's a really important question, because if in fact we're going to be seeing rates of 4 or 5% into the medium term, what this says is that the economic parameters that we've been used to for the last few years have fundamentally changed, and that could have a significant dent on property. It could actually have a significant dent in terms of equity markets. And by the way, it also means that people with money in the bank and term deposits will be doing a lot better. So there's a really interesting dilemma ahead, I think.
Yeah, we might talk about that commercial property where the cracks are starting to appear when we get to some of these other slides as well.
Absolutely.
Yeah. So CPI is still well above the RBA target band.
Yeah, so it was interesting that the mainstream media celebrated the fall in inflation, right? And it is coming down a little, but actually, if you look carefully, you can see that the core inflation is still relatively high and certainly well above the 2 to 3% band. The other point to make here, of course, in Australia, we've got this massive uptick in terms of the energy prices, particularly electricity prices. So typically up 25%, some up 40% down the East Coast. So there are already other factors. And if you take that and rents and other things, already you've busted the target for inflation. So the expectation I've got is we're going to see inflation not continue to come down, but turn and go up again. The reason for that is that the base effects, which is what we had a year ago. In other words, a year ago we had big uptakes that then dropped out. So that helped to bring the number down. But it seems to me that we probably are not going to see a nice gentle drift of inflation down towards the 2 to 3% band, which means that rates probably will have to go higher. But anyway, everybody celebrated this number, despite the fact it's still way, way too high.
Yeah, and that falls in that thesis we've spoken about before, where the official number could fall back into the target band and they're celebrating. But in the real world, if your rent's gone up 25%, your power bills are up 25 to 40%. You're just falling further and further behind, even if they're saying, hey, inflation's under control now.
Yeah, and you know, we've argued quite consistently that the way that CPI is being measured and reported is understating the true impact on many households, particularly those with less income to start with. So unfortunately, the whole story is skewed because the numbers are skewed.
Yes. Wages growing, but still well below inflation.
Yeah, and it's just worth underscoring this, that in real terms, people are still going backwards, and okay, wages growth is up a little bit. And it's interesting that the RBA was very worried about wages growth. And of course, in other countries, we've seen very strong wage growth. In the UK, wages growth is really strong at the moment, and that's a response to high inflation. In Australia, not so much so far, which means that ultimately, on average, people are still going backwards in real terms. But it's differentially distributed. So if you look at younger households, in real terms, their incomes have gone backwards for the last decade or so. If you look at older households, it's a little bit of a different story. But overall, people are having to spend more and more just to do the things they used to do, and their incomes are not keeping up.
Is there any structural things in particular, Martin, you think what the reason for the differential between the UK and Australia lagging?
So I think we are a few months behind where the UK is. So we had wages growth in the UK relatively low for quite a long period of time because people were expecting inflation to ease back. But then when it didn't, and we had significant upticks in food prices and other things, wage claims started to rise, and in fact public sector wage claims started to rise, and that then put another reinforcing upward hike in terms of the way that inflation's working in the UK. I suspect we'll see something similar in Australia. I don't believe that we're going to see wages staying in a negative position for that long. I think we're going to see more upward pressure on wages. And it's interesting, of course, that on one hand, the RBA is arguing for higher levels of unemployment to keep wages capped. The other point, of course, we've got very high immigration. High immigration in Australia is bringing a lot of people who are willing to work for a lot less. And I would also argue that one of the reasons why the wages growth is lower in Australia is that the migration's been a lot higher. And so that's another factor. Bear in mind, I'll show you in a slide in a second, high migration is a consistent now feature of the economy. It's a design feature, not a bug.
Yes. All right, so we've had a sharp rise in rental stress.
Yeah, this is pretty worrying. So I've updated my rental and mortgage stress numbers, and there was a very significant uptick. So rental stress is really hitting. It's actually now 68% of those in rental accommodation are struggling with cash flow. Mortgage stress is also up a little bit, so it's not quite as high relative to the rental stress, but these are both going the wrong way. Remember that there's still a lag between interest rates rising and it being hitting real households. So households are struggling now with cash flow, not universally. If you don't have a mortgage, if you own your property outright, if you've got a lot of savings, you're doing fine. That's about a third of households. But there are a lot of other households that are really up against it now. And there's more and more evidence of households struggling. So we're getting ever higher numbers of people ringing the debt helpline for assistance and advice. We're also seeing people, for example, in rental accommodation, trying to find cheaper rental accommodation, moving further out, in some case moving back with parents, and all those sorts of things are happening at the moment. So this is a very important leading indicator of what's actually going on. And unfortunately, I think we're going to see higher mortgage stress in the months ahead because the full thing hasn't worked through yet, as we'll see in the next few slides.
Yes, more pain ahead. So do you want to talk us through this chart a little bit more in terms of the older age groups versus the younger?
So what was interesting was last week we had the CEOs of the major banks giving evidence in front of the Economics Committee. And pretty much all of them said things are significant. But there was a very interesting quote from CBA who said a little more than 6% of the Reserve Bank of Australia's interest rate increases have yet to be felt by households. In other words, they're seeing a lot more impact. But they also released this piece of information, which showed that if you look at it by age group, and if you look at the spend per capita change from Q1 23 versus Q1 2022, you can see that younger households are actually spending significantly less, whereas older households, those with less mortgages, those with more savings, those with more assets, are spending quite a lot more. So one of the reasons why the economy and the momentum in the economy is still as strong as it is this differential spending power that we've got. We've got some households who've still got plenty of spare cash and are still spending, but others, particularly those with large mortgages and those in the rental sector, are under huge pressure. And in fact, the 25 to 29-year-olds are actually where the epicenter of the pressure is. And, the summary is under 35 on average 3.4%, compared with over 35 a growth of 7.7% year over year. That's a really important observation, bearing in mind where the inflation number actually is.
Yeah, and as you say, in general, these people have had their mortgage paid off. They might have a bit of savings, and they're now getting a high yield in that savings account. They already own another property, and they're getting the increased rent cash flow come through, as well as the stock market bouncing back a bit. So it's just that tale of haves versus have-nots, as you say.
Yeah, it is, and it's just underscoring again this bifurcation of the economy. Now, the point I'd make, though, from an electoral perspective, right? If you think of the next election, the shift of power is now underway because you've got more younger people. So if you draw a line at say 50 and go up and down, what you're seeing is you've got more people now who are actually really feeling it who are going to actually determine the outcome of the next election.
Mm.
So the politicians will have to actually take more notice of those younger people relative to previously because of the demographic shifts that are going on at the moment. And I think that'll be an interesting observation from a policy perspective. It'll be really interesting to see whether they actually start changing their policy and positioning because of this problem.
Yeah, that's a great point as well to watch. And this is a really good chart that shows all these mortgages that are about to roll over to higher rates.
Yeah, and people say, oh, there's no such thing as a mortgage cliff. Well, there is. It's just we just there now. So July is the peak month according to CBA. This is their data. Some have already rolled off, but there's a lot more still to roll off. The typical fixed rate was 2%. Now it's rolling over to 5 or 6%. So that's a huge impost. In some cases, the repayments are 40% higher. Now, some people are actually negotiating longer terms. The banks are trying to be flexible in terms of their negotiations to try and help people through. But nevertheless, the bottom line is the costs of people's mortgages are going to really hit. And as CBA said, the full impact of all of this hasn't yet been hit. This is going to take some months to work through. And that's the point I want to make. We are not at the end of this tightening cycle with regard to this fixed rate rollover, even if the RBA doesn't move again. And the risk is, of course, I said up front, is they might even also have to lift rates higher too. So we are in a significant tightening trajectory.
And household servicing costs, I think we showed this as well last time with the
I just wanted to sort of underscore it again because this is uptick, right? So this is what the whole point is. There's a lot more to come, and this is the real significant point, that we are not at the end of this tightening cycle. We're not at the end of the pain. And unfortunately, with the inflation outlook that I'm seeing with the high energy costs, as I mentioned before, I think this is going to be a very significant and painful period, not just for a few months. And remember what I said, rates are unlikely to come down later this year, maybe end of next year if you're lucky. So this is going to be a significant question. And rates may never come down to where they were in those artificially low. So this is a new normal that we've got to actually recognize that we've got. And then yet, of course, we've got massive amounts of debt for those with a mortgage because house prices have grew dramatically. And that then brings the focus onto, well, where are house prices going to go?
Yeah. All right. Next up, CoreLogic's home index values have bounced back a little bit this quarter, but still down year on year.
Correct. And what's interesting is that if you look at what's gone on, Brisbane actually had the year-over-year change of down 6.9, but they've had a bit of an uptick the last quarter. Not quite sure precisely how this is going to play out, and I'd make the point that these are actually the city. If you look at in the regional areas, prices have actually continued to drift lower, so we're not seeing the same recovery there. And my view is it's unlikely that we're going to see a massive amount of continued growth in prices, and potentially, I think, a slide because of what I said a moment or two ago. But the next slide is interesting because part of this was low listings. And in fact, until very recently, we were tracking, according to CoreLogic, listings levels that were well below the previous year or the 5-year average. But we've started to see something begin to tick up, and that is that listings are starting to sort of rise a little. And my hypothesis is, and based on my surveys, is that some investors are now wanting to get out while they can. And there's the first signs of depression and concern amongst owner occupiers, and some of those are now thinking, well, maybe I should sell and get out. And the banks are still encouraging some of that. So we might see in the weeks ahead a bit of a winter spike in terms of listings. Now, if listings started to rise, that would put potential downward pressure on property prices. So watch this space.
Yeah, as you say, it's unseasonal as well. So interesting to see what happens if the incline starts now and if it does continue into the summer where it traditionally ramps up.
Yeah, typically the spring season is a significant uptick anyway. But it's being brought forward. I think that's a sign of the pressure in the system.
Snapshot of building activity.
Yeah, this is quite interesting. So this is from the HIA, and they're just making the point that, with the supply-demand question, have we got enough properties, got a lot of people migrating in? Well, what they're saying is that the starts of new properties are actually dropping. The completions are roughly where they were, and the amount under construction sitting around the 100,000. But if this plays out, then we're going to see, from a new construction perspective, their argument will be we're not starting enough properties. Now, obviously, there are other arguments. 1 million spare properties across the country, according to the last census. A lot of property in Airbnb, which probably should be brought back, and a lot of vacant property. So this is not necessarily the full story, but it's quite interesting seeing effectively the HIA arguing that the new starts is now getting desperate at a time when, of course, we've got more building companies going under. We saw more this week. We've got a lot of structural issues and a lot of properties as well. So the quality that's being constructed is pretty low. And so this, I think, shines another light on some of the pressures that are actually on the property market in Australia.
And this isn't units as well, is it? This is just how houses.
This is actually the housing one, yes.
Yeah, I believe the total dwellings a year, is that about 160,000? Is that roughly the figure?
Yeah, it wobbles, but the thing about the approvals and the starts on the high rise, it's very blocky because, of course, by definition, if you start a new block, it's a big number. So, but this underlying trend for houses, I think, is pretty significant.
Yeah. Particularly when you consider what's going on with population growth here. And there's been some good articles written about Canada and Australia and all these countries doing very similar things with really crazy population growth.
Yeah. Well, of course, everyone's doing the QE in quantitative easing in population. If you can bring people in, you can make the economy bigger, and that then protects your GDP and makes you look as though you're managing the property, the whole economy well. But if you look carefully from the ABS, it's all about net migration, right? This is about bringing more people into the country. And, this is the quarterly numbers. And so we're basically bringing 100,000 a quarter of net overseas migrants into the country. They're talking about hundreds of thousands over the next 1 to 2 years, big numbers. Where are they going to go? Where are they going to live? Are they going to be able to buy property? All of those factors. But like I said earlier on, one of the interesting is that a lot of people are coming in and prepared to work for lower pay. And that means that it puts a downward draft on wages growth. But this is an unsustainable strategy that I think the government is executing. It's a big Australia strategy. And as you said, other countries are doing it too. We're all fighting for these migrants. It's not necessarily sensible strategy. And I think it's one of the real reasons why the economy is going to go through a very difficult patch.
Yeah, I'd be really interested to see some more granular numbers around skilled migration. What are the doctors coming in versus the people that are going to just be students and work on those lower wages to start with?
Well, certainly a lot of them were students initially, but that tailored away. We're certainly seeing a few more professional people coming in, but they've slackened the entry requirements for pretty much everybody. They've tried to make it easier and also try to make it quicker for people to convert to residency. So the government is doing absolutely everything to bolster these numbers and keep them high. I think it's bad policy.
Yeah. All right. New Zealand home prices have stabilised a little bit.
I thought we'd just touch on New Zealand briefly because New Zealand, of course, they did the interest rate rise quicker, so they were well above 5%. And the economy is pretty much flatlined. But what's interesting is that whilst there's been a considerable fall in house prices, now they've started to stabilise. And whether that will change, I don't know. But that again is partly a function of high migration, changes to the lending rules to allow people to borrow more, some further incentives to try and get first-time buyers to come into the market. And so they've pulled a whole bunch of levers to try and protect property prices from falling a lot further. Guess what? I think we'll see precisely the same initiatives and strategies bubbling across in Australia as well.
Yeah, I agree there for sure. Inflation in the US is falling more than forecast.
Yeah, so this is quite interesting. So we had a lot of data in the last week from the US, and they're now celebrating that inflation is coming down quite fast. There's a debate about whether the Fed will lift when they meet end of July. They probably will, but that could be the last. The interesting question is, though, will core inflation follow? And, is this really, as easy as it looks? And there's a few people arguing that, well, we'll probably get inflation down a bit, but trying to get it down towards their target, the last part of that, the last mile or so, will be very difficult. And they're arguing potentially that they will still have to lift higher. But the markets reacted very positively to this, so we started to see the markets bounce again. We've started to see people talking about a soft landing, that maybe things are not going to be as bad, maybe we won't get recession. So recession postponed, certainly, but there are other people thinking, well, hang on a moment, maybe enough has already been done in terms of the lift of rates. Remember, they moved them up dramatically from very low levels. It takes months for this to propagate through, and maybe we are going to see a recession in the US nevertheless. But there's a really interesting question as to whether there's a bit of a change in the weather, and in fact whether the Fed will be able to say we've lifted enough. So compare that with Australia, where things are much more adverse, or the UK, where they're even more adverse again. You could argue that the US is perhaps turning a corner, but too soon to say for sure.
Yeah, I was going to share my screen with you quickly, Martin, and show you. Have you seen this website, Trueflation? The guys that do it themselves over in the US and get millions of data points, and that's really come off by their calculations. So, like, as I said, if this tells me that there's a bigger recession risk in the US, and an interesting number to keep an eye on.
Yeah, absolutely. And all of the data points. So there was production costs looking flat. The jobs numbers were actually better than expected. So there were a whole series of tranches of data that all show that the US might be actually turning a corner, and it might possibly be that they will actually be able to call a halt in due course. But interestingly, most of the Fed chairs are still saying, no, we have to do more, and we're going to have to make sure that we actually have conquered inflation. So it might not be as quick as a lot of people are expecting. The markets aren't actually expecting a considerable turnaround in the short term, but they're now saying that maybe they've reached the sort of the peak. So higher for longer in terms of rates, but not necessarily more lifts.
Yes. Core inflation sticky in Canada.
Yeah, this is worth just remember I said to you core inflation in Australia is still pretty high. It's really sticky in Canada, and this is partly to do with wage rises, partly to do with rentals and a few other things. Canada lifted again after they paused, and I think this is an object lesson. It's going to be really tough to be able to get inflation back down to where it should be. And Canada's saying they might have to do more. So sticky inflation and core inflation is a subject that we're going to be talking about for many months yet.
Yeah. Chinese exports and imports both fell again.
Yeah, and it's just worth comparing that with China. So China's GDP came out overnight and was lower than expected. Their inflation rate is close to zero, and their exports are actually going the wrong way as well. So there's a big expectation now that China will stimulate their economy more. There's a huge number of young people in China, 15 to 20 million without a job, so unemployment's very high. And so the question is, what will they do? Will they do the same old, which is to try and build more stuff? Or will they effectively find a different strategy, perhaps try and encourage consumers to spend more or do something like that? Interestingly, there's a bit of a debate going on as to whether they should encourage some of these young people to stay at home and sort of support the family, and maybe the family members should support them. So there's a whole bunch of things going on. The Chinese economy is not looking very flash. International markets are assuming that the Chinese central bank will support the economy more. And if that's the case, that might be good for us. On the other hand, if China continues to be weak, they might not need so many of our exports, which might put downward pressure on the Australian economy. So this is one to watch.
Yeah, that's a fascinating point. I think I read in the article youth unemployment jumped from 20% to 21%. And culturally, it is more common for some of these people to have multiple generation households in some of these Eastern countries where they've got the older population and whatnot. And that's fairly normal. Whereas you look in Australia, how there's this shortage of aged care workers and community workers. And I was talking to some friends, I think I might have mentioned this last episode as well, where it's pretty easy these days to go out with low qualifications and get 50, 60, 70, $80 an hour to do some of this community service stuff, which in other cultures might be done for free by the family and that type of thing. So all that stuff is a big bill for the government if you're going to start paying everyone to do it in Australia rather than families doing it possibly in other countries.
Absolutely. I think it's a very interesting and important debate. And, structurally, there's a very different set of parameters in China relative to Australia. And as you say, we've got a huge question in Australia about aged care and how we deal with it. It's not actually an effective program at the moment. There's not enough money, there's not enough people. It's a very, very important demographic time bomb that we haven't really addressed. In China, they haven't necessarily addressed it particularly well. And as you say, the intergenerational families they've got there have a very different flavour. But more broadly, of course, if the Chinese economy continues to go sideways or down, that's going to create huge problems for them too. So different problems, but fascinating to compare the two.
Yes. Central bank policies are diverging, as you've mentioned the cuts and easing in China, as a lot of the Western world continues
Yeah,
to.
I quite like this Bloomberg map because it just shows you, in so many places, rates have gone really, really high. This is since the start of 2023, right? China, in blue, gone the other way, and a few others. It shows you that the atmospherics, though, are quite different across the world, but it also shows you that there are a lot of places where rates have gone really, really very high, which is going to put pressure on corporates, it's going to put pressure on households, it's going to put pressure on governments because of the cost of debt will be very, very high. And I think that the consequences of interest rate rises in terms of government debt has yet to be fully understood, because a lot of governments issued a lot of debt through COVID and even before COVID, and the rates were very low so they could service it well, but now they can't. So they're having to put a greater proportion of government money just to support the high levels. In the UK, for example, they have a very significant number of interest on their gilts, which is inflation protected. So as inflation goes up, they have to pay more for the gilts. So the government in the UK has a really big interest bill now, and I think other countries are going to face that. That's going to suck money out, and it means they're going to have less money to spend on other programs that they want, which is going to put more pressure on government spending. And so you've got to expect cuts in other areas.
Yeah, there's interesting pieces being written about Victoria's government debt and how quickly that's getting out of control. And I think, was it within 4 or 5 years, it's going to be double that of New South Wales, which is crazy.
Absolutely right. Yeah, it is crazy. And, the government debt problem, when interest rates rise, creates a huge, huge, huge problem. And unfortunately, I think Victoria is going to be an epicenter for a big problem down the track.
Okay, so this is the US 2-year government bond.
Yeah, and so just to say, look, bond rates have gone up considerably because of the expectation of future rates. I mean, there's still an inversion, the 210, so they're still thinking rates will come down in due course. But at over 4%, they actually touched 5% on the 2-year in the US for the first time for a long, long time. And that was an interesting and important signal. And yet, if you look at the exchanges, and I picked out the NASDAQ, the value of shares have gone really up a lot from their lows. The S&P is up 17% from the beginning of the year. NASDAQ potentially a bit more. We've got this really interesting contradiction. So we've got high interest rates, we've got bond yields, where they are, but you've still got markets believing that things are actually not too bad, and in fact, maybe markets should go higher. That there's a fundamental disconnect that I'm seeing here between what we're seeing and what markets are doing. And I don't know whether markets will go on higher, or whether in fact they're due for the next wave down. But that's the key critical question now, because the stock markets are reporting that earnings on corporates are not that flash. They're predicting lower than last year. The cost of debt is rising. Inflation may not be beat yet, but it could be beat later. So there's an interesting question as to whether markets are fundamentally overvalued. And I would argue, I still think they are. I think there's a lot of downside risk, but the markets have a way of just holding on to the hope that the Fed is going to cut and that companies will continue to outperform. And by the way, of course, within the NASDAQ, you've got the AI shares, 6 or 7 key shares. That is a significant proportion of the value growth. If you strip that out, things don't look quite as flash.
Yeah, I think they might even be rebalancing the Nasdaq. So those big
They're,
tech stocks.
they're trying to figure out what to do about that. Yeah.
And I guess that's the final point I want to make. What is anything? What is anything worth in this crazy world now? There's been so much money printed; it's got to find a home somewhere. But commercial property and real estate, and these real estate investment trusts, and all that type of thing. We saw Charter Hall. They had 15% of people wanting to redeem, and they said, "Oh, we can only give you 25% of your money at the moment because we don't think that we need to sell these assets in the real world, but we don't think the value that we're being get is fair value." And that's sort of straight out of the Ponzi textbook. It's like, well, hold on, the price of something is what someone's willing to pay, and you're saying we're going to limit how much you can sell. We saw this in the US with Blackstone, and we've seen it in other places as well. Now, these big, there's just not the liquidity there. There's no buyers for these big commercial property buildings as the aging population wants to rotate what their supers in or get out of some of their investment properties, commercial stuff. There's no buyers at the moment. That's a very dangerous house of cards, GFC style thing that can collapse and spiral very fast. And you'd probably see it get rescued by the RBA or the government.
Well, yeah. So the unlisted property, they don't have to mark to market as frequently as other types, so they can sort of extend and pretend a lot more. And it really only comes to a point of crisis when somebody wants to pull the money out. But if they do want to pull the money out, if confidence goes away, that could erode a whole bunch of value and could create a whole bunch of pressures. And of course, there's a lot of superannuation money in Australia put into these unlisted property assets, and that's a problem. So I wouldn't be surprised to see significant pain in the months ahead there. And the risk of further government bailout is pretty high because everyone will be worrying about financial stability, right? So they're worrying about it in the mortgage sector, they're worrying about it in the commercial property sector. Financial stability is king, unfortunately, and that means that you've got to expect some more unnatural acts to try and protect financial stability at all costs.
Yeah. In their defense, they did say we're going to pay out another lot soon, and we'll try and have all your money to you by the end of the year. But that just reminded me of when all those banks start to go under the US, and as soon as there's the first signs of blood in the water, and people go, "What do you mean we can't get all our money out now?" And then it becomes a race to the exits for similar investment products, and that's when the collapse starts.
Yeah.
And that we saw how quickly that happened in the US with big banks. So it's something that can happen quicker than you expect once it starts.
It's about confidence, right? Confidence is the critical thing in the markets, and confidence can erode extremely quickly, particularly these days with everything, with all the information flowing around much more quickly and with the ability to move money much more quickly than previously. As we saw in the regional bank crisis, it doesn't take much to tip things over the edge. And that's another thing to watch, right? Because as soon as some people start getting a sniff of something not good, then they're going to actually try and act quickly. So that's another reason why I always say be cautious and careful about what's going on, and don't necessarily put all your eggs in one basket.
Yeah. Well, Martin, another fantastic episode. Keep enjoying your time over there in the UK, and we'll talk to everyone again next month.
Cheers. Thank you very much.